Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Hi, everyone, and welcome to this discussion on income taxes, where we're going to be dealing with IAS 12 from full IFRS and also Section 29 of the IFRS for SMEs. My name is Anton van Wyk, and I will be leading this session for you, and I hope that you find this very beneficial. On the screen, you can see my contact details, so you are very welcome to send me an email or to phone me on my cell phone if you wish to discuss the content of this particular discussion. All right, so let's get cracking with IAS 12 and Section 29 of the IFRS for SMEs. Firstly, I just wanted to bring to your attention the concept of full IFRS versus the IFRS for SMEs. Now, if we look at full IFRS, as I said, IAS 12 is the standard that deals with income taxes in full IFRS, and IAS 12 has abolished the partial approach or partial basis of deferred tax calculation many years ago. So we only allow the comprehensive basis of calculating deferred tax in respect of all our qualifying temporary differences that relate to all of our assets and liabilities. Now, with the IFRS for SMEs, we used to have a different approach, but the good news is that whether we called that a partial approach or just calculating deferred tax under certain circumstances, the good news is that IAS 12 and Section 29 have been fully aligned, and that already happened with the latest updates to the IFRS for SMEs that happened in the year 2015. So there has been no difference in the calculation of deferred tax specifically between full IFRS and the IFRS for SMEs between these two documents. All right. Now, in respect of the IAS 12 principles, I'm going to mostly obviously refer to IAS 12 because that by default will then obviously be referring to Section 29 as well. So the IAS 12 principles that we're going to be discussing in this session will relate to, firstly, recognition. So we need to understand the basis on which deferred tax is calculated, as well as the approach that we follow when we calculate deferred tax, because I think in order for us to understand tax, it is important to understand the approach that we follow to calculate the deferred tax in respect of assets and liabilities. So you'll see that there has been a very definite shift away from the income statement approach towards what I call the balance sheet approach or the asset and liability approach. So we're going to be talking about that in a short while. Measurement obviously is very important because there are many things to measure when you calculate tax. You need to measure the carrying amounts of assets and liabilities, although IAS 12 and Section 29 do not tell you how to measure carrying amounts of assets and liabilities. That's where all the other standards come in. But IAS 12 and Section 29 basically focuses on the measurement of tax bases and then the identification of qualifying temporary differences. And I would like for you to just make a note that not all temporary differences attract deferred tax. And that is why it's so important that we effectively look at some exceptions to the calculation on deferred tax. And that is where part 2 is going to be very relevant in respect of this short course on income tax. So measurement is going to be a big focus of this session. Presentation happens on the face of the financial statements, so we need to just understand where the presentation happens, what will be presented, the fact that income tax can be presented in profit or loss, but that income tax can also be presented within other comprehensive income when that particular tax relates to items of other comprehensive income. So just a quick example, a revaluation surplus on property, plant and equipment will obviously attract income tax because of the revaluation that is done from an accounting point of view, but not from a tax point of view. So such revaluation surplus is recognized and accounted for within other comprehensive income. And therefore the corresponding tax must then also be accounted for in other comprehensive income. So all of those are presentation issues. And then lastly, how to disclose income tax, and that obviously relates to the notes to the financial statements. And I know that many people struggle not so much with the income tax side of it, but more so with the tax rate reconciliation, understanding what that long and tedious tax rate reconciliation actually is and what it relates to. So we'll be focusing on that, as well as what the disclosure requirements are in respect of deferred tax that appears in the statement of financial position, or the balance sheet, as we call it, in more day-to-day terms. So I think we should make a start with, this particular section. So as you know, the short course is broken into two parts. Part one dealing with the recognition and the measurement of income taxes. So that's quite an exciting part, to discuss. And on slide number 4, I listed the learning outcomes for you as well. All right, so if we just quickly have a look at that, understanding the need for deferred tax and the philosophy behind its calculation. And when you start talking about philosophy and things like that, people tend to disengage a bit. Now, I don't want you to disengage, because there's a reason that I want to discuss the philosophy. If we understand why deferred tax is calculated and why we need to account for something that clearly relates to the future, then you'll also understand what the inputs are that you are looking for when calculating that tax. All right, so that's why it's important to understand, firstly, the why behind especially deferred tax calculation. Then I'm going to focus on the assets and liabilities approach and how that differs in respect of the income statement method or income statement approach that is followed by many people. So that means that our deferred tax is calculated using assets and liabilities. And we'll understand that assets and liabilities look into the future. Your balance sheet or your statement of financial position is a document that is a snapshot, but it does tell you something about the future of an entity. And we'll talk about that in a short while. Then we need to investigate what the tax bases are of assets and liabilities. That's very important, so that we can understand how to calculate them correctly under various circumstances. And sometimes it can get quite challenging to calculate the tax base of assets and liabilities. And then using carrying amounts and tax bases to firstly identify temporary differences, then to decide whether these temporary differences are qualifying temporary differences, because only qualifying temporary differences will attract deferred tax. So it's very important right at the beginning that you already make note for yourself that not all temporary differences attract deferred tax. We need to make sure that temporary differences that we've identified, being the fact that the carrying amount on the one side differs from the tax base on the other side. All right, so there's a difference between carrying amount and tax base that we obviously need to take into account, number one. But secondly, such a difference is not automatically a temporary difference. And we need to decide whether we have qualifying temporary differences that attract deferred tax. All right, so on slide 5, this is where we start talking about the philosophy. Why do we accrue deferred tax? Now, firstly, what is deferred tax really? Now, on slide number 6, you will see that when you ask people what deferred tax is, the majority of accountants will say it's the difference between accounting and tax. Now, I say that is the most common explanation that I hear from qualified accountants as to deferred tax. It's the difference between accounting and tax. But what is that difference? Does it make sense to say there's a difference, and that because there's a difference in accounting versus tax, we automatically accrue tax for that in the form of deferred tax? To me, that doesn't make sense. So we need to find a different explanation. Secondly, people say that we are matching tax to accounting profit accrued. Now, maybe some people can find peace in that explanation. I cannot. The reason for that being that the matching concept hasn't been a focus point in IFRS or the IFRS for SMEs for many years. So we do not account for transactions by primarily trying to match them. We focus more on the balance sheet side of a transaction these days than on the income statement. So the approach in IFRS is that if we get the balance sheet side correct.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.